They thought the close was the kill shot. They wanted red candles, panic, surrender. But look closer. Because while New York shut the lights off, something woke up in the dark. A move so fast, most people won't even notice it happened. Until tomorrow morning, when the ones who shorted this metal realize they didn't win. They walked into a trap, and the next few hours could decide everything. Welcome back to Market Metal. If you're watching this and you're over 50, like a wise elder who's seen a few storms before, do me one favor. Don't just watch, subscribe. Because calm minds win when markets get loud. And tell me in the comments, where are you watching from today? The closing bell event, what actually happened. At exactly 4:00 p.m. Eastern Time, the New York trading session ended. Silver closed at $80.59. On the surface, it looked like a simple decline. The price had fallen 1.77 from the previous close. Financial headlines would later describe it as profit-taking or a pause in momentum. But serious observers did not stop at the headline number. They looked at how it closed. During the final hour of trading, volume increased sharply. Roughly 47,000 contracts changed hands in that last hour alone. Over the past month, the average volume during that same window had been closer to 31,000 contracts. That meant selling pressure was not casual, it was deliberate. Large orders entered the market in waves, pushing price lower into the settlement print. For experienced capital managers, the timing was not random. The final hour matters because the closing price shapes perception. Fund managers mark their books at settlement. Media outlets report that number. Algorithms recalibrate off that number. A close below a key level, such as $81, can change sentiment quickly. Silver had been holding near $81 for days. It had become a psychological floor. Many traders view round numbers as anchors. Breaking below them can trigger stop losses and shift positioning. When price fell beneath $81 in the final minutes, the move appeared decisive. To an inexperienced observer, it looked like the market had rejected higher prices. But the story did not end at 4:00 p.m. When the New York floor closed, electronic trading did not stop. The Globex overnight session opened immediately. Within 90 minutes, silver began to recover. It climbed back toward $80.80, then $80.90. By early evening, it was approaching $81 again. This detail matters. After-hour sessions are thinner than regular trading hours. Retail investors are rarely active. Liquidity often comes from institutions, international desks, or algorithmic systems adjusting exposure. A meaningful recovery during that period suggests participation from informed capital rather than emotional traders. The reclaim of $81 in after-hours trading changed the structure of the day. A breakdown that holds into the close often signals continuation. A breakdown that is quickly reclaimed signals failure. Professionals call this a failed breakdown. It is not dramatic. It is not emotional. It is structural. It tells them that sellers were aggressive into settlement but were not able to sustain control once the bell rang. Why does that matter? Because markets do not move based on single prints. They move based on positioning. If traders sold aggressively under $81 expecting follow-through, and the market reclaims that level overnight, those sellers are now exposed. Their thesis depends on continued weakness. Without it, they must reconsider. The next question becomes simple. Was the late session decline based on new information, or was it liquidity-driven? No major economic report was released in the final hour. There was no sudden policy announcement. There was no geopolitical shock. The selling appeared technical rather than fundamental. It occurred during a period when order books tend to thin out, and when large players can move price with relatively smaller capital compared to peak hours. That does not imply wrongdoing, it implies structure. Futures markets are leveraged systems. When bids are thin and stops cluster below obvious levels, price can move quickly. Once those stops trigger, momentum accelerates. But when that move reverses just as quickly, it suggests the market absorbed the pressure. For business leaders and entrepreneurs watching from outside the trading world, this may seem like noise. It is not. Commodity prices feed into manufacturing costs, supply chain planning, and capital budgeting. A failed breakdown can signal that demand remains firm beneath the surface. Silver is not only a monetary metal, it is an industrial input used in electronics, solar panels, medical equipment, and defense applications. If price refuses to stay below support despite concentrated selling, it may indicate that structural buyers remain active. By reclaiming $81 ores after hours, silver did more than bounce. It challenged the narrative formed at 4:00 p.m. It suggested that the decline might not represent a shift in long-term demand, but rather a temporary liquidity event. For serious decision makers, the focus is not on excitement. It is on probability. Two possibilities now exist. First, the reclaim holds. Asian and European sessions confirm strength. New York opens above $81 the following morning. In that scenario, the late sellers may need to adjust positions quickly. Second, the reclaim fails. price slips back below $80.50 overnight. The breakdown resumes. In that case, the close at $80.59 was the beginning of a deeper correction. At the moment the bell rang, it appeared that sellers had control. 4 hours later, the market told a more complicated story. The closing bell event was not the end of the move. It was the beginning of a test. Serious observers understand that markets often reveal intent not at the moment of impact, but in the reaction that follows. Silver's reaction was not collapse, it was resilience. And that is what makes the next session critical. The liquidity architecture behind the move. The close at 80.59 was not the full story. It was the visible result of something deeper, an interaction between liquidity, leverage, and timing. In modern futures markets, price does not move simply because buyers or sellers feel something. It moves because liquidity either absorbs pressure or disappears, and on that Tuesday afternoon, liquidity briefly disappeared. Between 3 p.m. and 4 p.m. Eastern Time, 3 distinct waves of selling entered the silver futures market. The first wave pushed price from $81.40 toward $81. The second drove it below $81. The final wave, minutes before settlement, forced it down to $80.59. On paper, that appears like consistent supply. But professionals do not only watch executed trades, they watch the order book, the visible depth of bids and offers. In the minutes before the first wave of selling, the bid stack below market price began to thin. Orders that normally sit at predictable intervals, 10 cents apart, were no longer there in normal size. Liquidity was reduced. When the first block of contracts hit, there was less resistance than usual. This matters because markets are leveraged systems. A futures contract controls 5,000 ounces of silver. Participants post margin rather than full value. When price drops through visible support, automated stop-loss orders activate. These are not emotional decisions. They are mechanical triggers. When bids are thin and stops are clustered, price can move faster than fundamentals justify. This phenomenon is sometimes described as an air pocket. It is not dramatic language. It is structural description. If the cushion of buy orders is removed, price can fall rapidly through space that would normally require much larger capital to cross. The final hour move displayed characteristics of such a liquidity gap. The decline to 80.59 required significant volume, but not extraordinary volume by historical crisis standards. It was enough to push through support, but not enough to suggest systemic panic. Then something changed. At 4 p.m., the official settlement locked. Institutional accounting adjusted to the closing price. Headlines formed. But when the Globex session opened seconds later, bids reappeared. Not small bids. Visible, structured bids, orders of 500 contracts, some at 1,000 contracts. Placed deliberately at incremental price levels, they were not hidden. They were displayed. Displayed size and after hours, trading sends a message. It signals willingness to absorb supply. It indicates that a participant is comfortable being seen accumulating. This was not retail behavior. Retail participation during that window is minimal. Most individual traders do not operate actively in thin overnight futures sessions. The pattern suggested institutional repositioning. Within 90 minutes, silver climbed toward 80.85, then toward 80.95, approaching $81 again. The timing raised important questions. Who buys aggressively immediately after a settlement-driven sell-off? One possibility is short covering. Traders who sold aggressively into the close may have reconsidered when price stabilized, but short covering typically appears reactive and uneven. This recovery was measured. Bids stepped upward in structure. The climb was orderly, not chaotic. Another possibility is international participation. The Asian trading window overlaps with early Globex hours. Institutional desks operating from Shanghai, Singapore, or Hong Kong are active during that time. These desks evaluate Western session closes differently. They often interpret late session breakdowns as opportunity rather than confirmation. For strategic observers, the significance was not simply that price rose. It was that the reclaim occurred in low liquidity hours, where only deliberate capital typically acts. Liquidity architecture explains more than emotion ever will. When liquidity is pulled into the close and restored immediately afterward, it suggests a tactical maneuver rather than a thesis shift. Markets sometimes test levels aggressively to discover where true demand resides. In this case, demand appeared under $81. That level had been tested intraday before. It had held repeatedly. When it was briefly breached into settlement, it appeared vulnerable, but the rapid restoration of bids suggested the breach may have been temporary. For business leaders watching commodity inputs, this pattern carries meaning beyond trading desks. If price cannot remain below a psychological threshold despite concentrated selling, it may indicate that underlying demand remains strong, that demand may come from industrial hedgers, sovereign-linked buyers, or strategic funds reallocating capital. In leveraged markets, positioning becomes unstable when expectations and reality diverge. If participants sold expecting follow-through and instead encounter stabilization, they face a decision: maintain exposure or reduce risk. This is where tension builds, not on headlines, but inside clearing firms and risk departments, because the futures market does not forgive extended miscalculations. As silver hovered near 80 yuan as in the evening session, the structure of the market shifted from apparent weakness to potential trap, not a dramatic trap, a structural one. If price holds above reclaimed support, those who initiated positions below that level must evaluate their tolerance for further upside exposure. Markets rarely announce turning points with certainty. They reveal stress through behavior. The behavior following the close suggested that liquidity was not collapsing. It was rotating, and that shift in liquidity architecture sets the stage for what happens when the next major session, Asia, then London, then New York, engages with a market that refused to stay down. The structural supply constraint. The after-hours recovery above 81 $1 was not only about liquidity, it was about something deeper, something structural. Short-term price movement often distracts from the underlying architecture of a market. But serious observers know that when a breakdown fails repeatedly, the explanation is rarely emotional. It is usually mechanical. And in silver's case, the mechanics extend beyond a single trading session. To understand the tension building beneath the surface, one must examine the relationship between paper claims and physical supply. As of the most recent data, total open interest in COMEX silver futures stood near 182,000 contracts. Each contract represents 5,000 ounces of silver. That translates to approximately 910 million ounces represented in futures positions. At the same time, registered inventory, the silver available for delivery against those contracts, stood near 47 million ounces. This ratio matters. It implies that for every ounce of deliverable silver, nearly 19 ounces are represented on paper. Futures markets are designed for leverage, not full physical backing. Most contracts are closed before delivery. That is understood. But high leverage amplifies sensitivity. When positioning grows large relative to available inventory, the margin for error shrinks. A failed breakdown at a key level becomes more significant in such an environment. Because if the market begins to move against concentrated short exposure, covering pressure can develop quickly. This dynamic has appeared before, not as spectacle, but as structure. The silver market in 2026 is not operating in isolation. Industrial demand remains firm. Solar panel manufacturing, electronics production, and advanced energy systems continue to consume silver in significant quantities. At the same time, global mine production has not expanded proportionally. Estimates for 2025 suggest global mine output around 830 million ounces. Combined industrial investment, jewelry, and silverware demand approached or exceeded 900 million ounces. That gap, however it is filled, creates a structural deficit. Deficits do not immediately explode prices. They erode buffer capacity. They reduce flexibility. They tighten the space between supply and demand. When a market operates in structural deficit, breakdowns often fail because physical demand absorbs weakness. The paper market may move quickly, but the underlying buyers do not disappear. International dynamics add another layer. Shanghai's silver inventories, reported monthly, stand significantly larger than COMEX registered supply. While precise figures fluctuate, the scale difference is substantial. This does not mean one exchange controls price. It means physical reserves are geographically uneven. When Western sessions push prices lower, Eastern participants sometimes view those declines through a different lens. They evaluate physical acquisition opportunity, not short-term chart damage. Repeated failed breakdowns can indicate that the marginal buyer is not retail speculation, but strategic accumulation. This is where tension builds, not on social media, not in headlines, but in clearinghouses. If price holds above reclaimed support and begins to advance, participants who added short exposure into weakness may find themselves exposed to margin expansion. In leveraged markets, a 10-cent move matters. A $1 move compounds quickly. Consider the arithmetic. A participant short 5,000 contracts controls 25 million ounces. A $1 move against that position represents $25 million in mark-to-market exposure. Even partial exposure creates meaningful pressure. When multiple participants share similar positioning, and when liquidity above current price is thin, covering becomes self-reinforcing. This does not require conspiracy. It requires imbalance. The reclaim above 81 Sauer suggested that imbalance may be forming again, not because price rose dramatically, but because it refused to stay below support despite concentrated selling. History provides precedent. In January and early February, similar late session declines were followed by overnight recoveries and subsequent advances over the next 48 to 72 hours. Markets often repeat structural behavior when the underlying conditions remain unchanged. The structural condition here is leverage resting atop constrained supply. Entrepreneurs and business leaders may ask why this matters to them. Because commodities transmit signals about capital allocation. When hard assets resist breakdown in the face of aggressive selling, it may indicate that institutional capital is hedging against macro uncertainty. Debt levels remain elevated globally. Central banks operate within narrow policy corridors. Inflation has moderated from prior peaks, but remains above long-term targets. In such environments, tangible assets often regain strategic importance. Silver occupies a unique position. It functions both as industrial input and monetary hedge. When confidence in financial systems tightens, dual demand assets can respond asymmetrically. The reclaim of $81 was not confirmation of breakout. It was confirmation of tension. If physical demand continues to absorb paper-driven weakness, the imbalance grows. And when imbalance reaches threshold, repricing does not unfold gradually. It unfolds rapidly. The structural deficit does not announce itself loudly. It expresses itself through repeated failure of breakdowns. Silver's behavior in the hours after. The close suggested that beneath the volatility, demand remains anchored. The question now is not whether price moved overnight. The question is whether leverage and supply constraints will collide again when the next major session engages. Because when structure overrides sentiment, markets move with purpose. Strategic implications. What this means for decision makers. The reclaim of 81 orders noirs was not a celebration. It was a signal. In financial markets, failed breakdowns carry more weight than successful ones. A confirmed collapse often reflects new information. A failed collapse reflects positioning stress. For business leaders, entrepreneurs, and capital allocators, this distinction matters. When a key level breaks and immediately reclaims, it suggests that capital was waiting. It suggests that price weakness was not interpreted as deterioration, but as opportunity, and that changes forward risk calculations. The next 48 hours become critical, not because of drama, but because of exposure. If silver holds above $81 and pushes toward $81.50 and beyond, those who added short exposure into the close face incremental risk. In leveraged environments, incremental risk becomes forced action. Clearing firms adjust margin requirements. Risk managers reassess volatility assumptions. Positions that looked stable at settlement begin to look unstable at dawn. Markets do not reverse because of emotion. They reverse because of imbalance. An imbalance, once triggered, can cascade. The first test level above $81 sits near $81.50, recent resistance. Above that lies $80.30, the short-term moving average zone. Beyond that, we're $83.10, the prior swing high. If price advances through those levels with volume, the narrative shifts rapidly from correction to continuation. In that scenario, late session sellers are not merely wrong, they are trapped. Conversely, if silver slips back below $80.50 overnight and fails to regain support, the reclaim was temporary. The breakdown resumes. The burden of proof shifts back to buyers. Serious capital does not rely on prediction. It relies on scenario planning. Two paths exist. Path 1, confirmation. Above reclaimed support, accelerated covering, extension toward $84, $85 in short order. Path 2, renewed weakness, retest of $79 liquidity rebuild before another attempt. For decision makers, the priority is not guessing which path unfolds. It is preparing for both. Hedging frameworks must account for asymmetry. If downside risk appears limited relative to potential upside acceleration, position sizing adjusts accordingly. If volatility expands without direction, exposure is reduced. The macro overlay intensifies the stakes. Global sovereign debt levels remain elevated. Monetary policy operates within narrow constraints. Central banks cannot tighten aggressively without stressing debt markets, yet easing risks, reigniting inflationary pressure. In such environments, hard assets often serve as balance sheet insurance. Silver's dual role, industrial and monetary, makes it particularly sensitive to shifts in capital allocation. When financial actors question currency stability or debt sustainability, they seek tangible alternatives. When industrial demand remains steady, downside becomes self-limiting. This is not about sensational price targets, it is about structural positioning. If silver continues to resist breakdown despite concentrated selling, it implies that large pools of capital are reallocating. That reallocation is rarely short-term. Entrepreneurs watching this unfold should consider the broader message. Commodity resilience in the face of tightening liquidity often precedes cost pressure in manufacturing sectors. It can signal input volatility ahead. It can influence procurement strategy, inventory planning, and pricing decisions. Markets often transmit warnings before they transmit headlines. The closing bell event on that Tuesday evening was not decisive. The hours that followed introduced doubt into what appeared decisive. If the reclaim holds, the lesson is clear. Markets operating under structural deficit conditions do not collapse easily. They compress tension until repricing occurs. If it fails, the lesson remains. Leverage cuts both directions, and patience is required. But the most important insight lies elsewhere. Silver did not collapse when pushed. It absorbed pressure and stood back above a critical threshold. That behavior, in professional risk language, is called absorption. Absorption is what happens when informed buyers accumulate into weakness without chasing strength. It is disciplined, it is strategic, and it is rarely visible until the move is already underway. The next trading sessions will confirm whether absorption was genuine. If it was, the reclaim of $81 where those are will be remembered not as a bounce, but as a structural pivot. For serious observers, the message is simple. Do not focus on the noise of the close. Focus on the reaction. Because in leveraged markets under supply constraint, reaction often tells the truth before price does. And the truth is emerging, quietly, methodically, beneath the surface.